Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
All right, welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. So the first question is from Tim, and he says, I think Republicans are really supposed to be good for the stock market. So don't you think this is a no-brainer that the markets are going to do well? Tim, I know historically Republicans were better for the financial markets than Democrats were. At least, that's what has been said. But, I'd like to point a couple things out to you. I mean, first of all, during the George Bush Senior administration, right, the stock market really wasn't that great. Now it was good during the Clinton administration. It wasn't so great again during George W. Bush administration. And it was great again during the Obama administration, right? So I'm not saying that it's going in the opposite direction, Tim. I'm not saying that at all, that all of a sudden, Democratic administrations are better than the Republican administrations. What I'm saying is, I think those old rules of thumb may be outdated. And we can't go by those quite as much because, we've realized that a lot of the decisions are made in a much bigger way than just who's sitting in the White House, right? So maybe one point, to your argument, Tim, is yes, the Republicans now are they're in the White House, but they also have the Senate and the House, at least by a small majority in the House, right? So that might be an argument as to why it's good for the stock market, because they control all three, but not just because it's Republican. So to support your point, on that side, but also remember the Federal Reserve is its own separate entity, right? And I don't think, even though, he's been talking about it, I don't think President Trump or President-elect Trump can come out and just oust Jerome Powell from the Federal Reserve. Although, they can appoint somebody different when the term is up next year, but that's a long ways to go, right? We have to want to say like a year and a half before his kind of tenure is actually up, right? So I wouldn't jump to that conclusion. There are some kind of great things about President Trump's presidency or President-elect Trump's presidency, right? I mean, his intended policies being more pro-business, more pro-business is usually better for the stock market. But there's also a lot of, kind of headwinds, that you have to kind of take into account. And specifically speaking about income investing, which I know is crucial for many of you approaching retirement. We need to kind of look beyond just market performance. We need to consider how different policies might affect dividend-paying stocks, corporate bond yields, municipal bonds, all key components of a retirement income strategy. Remember, sometimes what's good for the overall market isn't necessarily optimal for income-focused portfolios. Tim, thanks for your question. I know I've talked about different kinds of investments and income-generating strategies that work kind of regardless of which party controls Washington in the past, and that's something that you should keep on listening for. So great question today from you, Tim. I appreciate that. Hey, if you would like to send in your question like Tim did, hopefully answer that, you can email it to poollocke@poollocke.com. Moving on to our second question, that's from Arnold, and he says, all right, well, how about the national debt? If we lower taxes, that means that there will be more deficit spending. So how does that make sense? All right, Arnold, that's a good question. And obviously, there's a concern that eventually the merry-go-round will stop, right? That essentially it's a big Ponzi scheme, right? Unless you're a MMT, right? A modern monetary theorist person, which you probably aren't. that also we're going to get more debt. We're going to be, are we going to be able to support it? And we're going to have to really tighten up as a country in order to kind of get there. And that's a legitimate concern, right? I mean, yes, the deficit did grow under the first Trump administration significantly, right? And a Biden administration didn't do anything to fix it, right? It just kept it, made it worse. And we have a feeling, that could happen again. And you're right. If you have lower taxes, well then, we get less revenue and we get bigger deficit and we need to borrow more money. But there's another problem, right, Arnold? You may not, this is something you may not be thinking about, and that's interest rates, right? That's important. And, short-term interest rates are set by the Federal Reserve. And they keep lowering those rates, right? But long-term interest rates are sticky. And they're in the mid-4s right now, and long-term interest rates are really what drives the economy, right? So when you borrow money for a house, you borrow money for a car, you borrow money for anything, really. Corporate borrowing of money doesn't matter. Usually, it's based on long-term interest rates. Now, those don't seem to be going down, which means it might be less beneficial for the economy than we think, because long-term rates have to go down. And unless we have recession, it's unlikely that that happens, right? At least at this stage, because people are expecting Trump to be able to miraculously grow the economy at an increasing rate. And that, which supports long-term interest rates, really. But the second thing it does, Arnold, it means that the interest rate on our government debt remains high. It's going to stay high. So all those lower interest rates, right? Those bonds, when they come due, those need to be refinanced at a higher interest rate. And therefore, that's going to increase our kind of cost of carry. It's going to increase our budget, that we need to pay more and more just to kind of support the current national debt. And to make it even worse, if we're constantly issuing more debt, it means that there's only so many buyers who want to buy the debt. And, we've had treasury auctions that have been challenging so far, right? And this is particularly important for income investors to understand. When government debt becomes less attractive to buyers, it can actually create opportunities in other income-producing investments, corporate bonds, preferred stocks, and even dividend-paying stocks. They might become more attractive, an attractive alternative, so to speak, for income-seeking investors and institutions looking for yield in different places. So we might have more kind of, which means now the government has to pay kind of even higher rates to attract buyers. Now, this creates what we call a crowding out effect, right? Where private investment kind of gets squeezed because so much capital is being absorbed by government borrowing. For those of you focused on generating retirement income, this means you need to be especially vigilant about diversifying your income sources. So again, that's the negative. I think you hit it kind of the nail right on the head, is that deficit spending could hurt things. But Arnold, I hope that, you kind of listen to the show in the past, in the future, because we talk a lot about kind of the good, the bad, and the ugly of this situation, right? Like this kind of what we call triple red economy, right? And financial markets. So that we're going to have over the next 2 years, maybe 4 years, we'll see. And there's lots of strategies that we always talk about protecting your retirement income in this challenging environment, regardless of the political party in charge. Hey, Thanks for your great question. And if you would like to have your question answered, you can do so by emailing it into poolelock@poolelock.com. If you like what you heard, go ahead and like and subscribe to our channel. I am James Locke, your retirement income source. See everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.